Okay, so you want to buy a prison. Not rent it, not manage it for a few years and walk away. Own it. The concrete, the razor wire, the cell blocks, all of it. Here's the first thing nobody tells you. The money isn't in locking people up, it's in making sure the beds never sit empty. That's not a metaphor. Some of these contracts are written so the government pays for a set number of beds whether anyone is sleeping in them or not. Picture a hotel that gets paid for 100 rooms a night no matter how many guests show up. That's the deal. And by the end of this video, you'll know exactly why that clause is worth more than the building itself, where the second, quieter revenue stream actually lives, why the company that looks most profitable on paper might also be one bad election away from losing everything, and what actually happens when you run the real numbers side by side on owning one of these facilities versus simply owning a piece of paper that says you do. The myth. Here's what people assume. They picture a business built on punishment, a company that profits every time someone breaks the law. Lock up more people, make more money. Simple, grim, done. It's the version of this industry that shows up in headlines and documentaries, a machine that manufactures crime to feed itself. It's not that simple, and honestly, it's not even the interesting part. The actual business isn't crime, it's occupancy. A prison company doesn't get rich because crime goes up. It gets rich because it convinced a government to sign a contract that pays out almost like a subscription, a guaranteed floor of revenue that shows up whether the facility is half full or packed to the ceiling. Crime rates can fall for a decade straight, and if the contract terms stay the same, the revenue barely notices. That distinction changes everything about how this business actually runs, who profits from it, and, more importantly, where the real risk is hiding. Because if the money isn't really about crime, then the thing that can hurt this business the most isn't a change in policy. We'll come back to that. The real cost. So what does it actually take to get into this? You're not opening a lemonade stand. A mid-sized correctional facility can run into the tens of millions of dollars to build before you've hired a single guard. One case that keeps showing up in industry records is an Ohio state prison sold to a private operator for a little over $72 million back in 2012. That's the entry fee, before staffing, before insurance, before a single meal is served. And that facility wasn't built from scratch. It was an existing building already standing, already staffed. Build from the ground up, and the number climbs fast. Then come the fixed costs that never stop. Staffing a facility 24 hours a day, 7 days a week, 3 shifts deep, and correctional staffing is notoriously hard to keep full, which means overtime, which means the labor line rarely comes in under budget. Food service for a population that doesn't get to skip meals. Medical care, which in this industry is often its own separate outsourced business, meaning you're paying another company to keep your captive population alive and, ideally, out of the news. That healthcare subcontracting world is smaller than you'd think. A handful of private equity-backed providers dominate it, and at least one of the largest players in that space filed for bankruptcy protection in the last couple of years, buried under lawsuits over the quality of care. Insurance. Liability coverage, which gets more expensive every time a facility makes headlines for the wrong reason. And the maintenance of a building that's designed structurally to be almost impossible to walk out of, which is its own category of expensive. Add it up, and the entry price alone would scare off most investors. So why do companies keep building? Why does an industry with this much overhead, this much liability, and this much bad press keep expanding? Because of the clause. The real mechanism. Here's the part that makes this business genuinely clever in a way that should probably make you a little uncomfortable. The core contract is a per diem rate, a daily rate the government pays for every person housed in that facility. Sounds straightforward, but the leverage isn't in the rate, it's in the guarantee attached to it. Many of these contracts include a minimum occupancy guarantee, sometimes 90%, sometimes higher. That means the government has agreed, in writing, to pay for that occupancy level even if the population drops below it. One state facility's current arrangement pays roughly $48.50 per person per day at a guaranteed occupancy of 95%. Multiply that across nearly 2,000 beds every single day for years, and you start to see why this isn't really a punishment business. It's a real estate business with a captive tenant the landlord never has to chase for rent, never has to evict, and never has to worry about vacancy. The building doesn't need to be full, it just needs the contract to say it's supposed to be. But that's only the visible layer, the number a state auditor might actually see in a budget line. The quieter money, the part that rarely makes it into a press release, comes from what happens inside the walls after the person is already there. Phone calls. For years, a 15-minute call from a state facility could run close to $2, sometimes far more depending on the state and the provider. Some companies built entire single-call products that charged flat fees north of $15 to $20 for one short call, no minute math required, a flat toll just to hear a voice on a Sunday. And here's the twist, the facility often gets a cut of that phone revenue. Commission rates on prison phone revenue historically have run anywhere from around 40% up to almost 80% flowing back to the correctional system that granted the contract. So the phone provider profits and the facility profits, and the person paying for all of it is usually someone on the outside, a parent, a partner, a kid, just trying to hear a familiar voice for 10 minutes on a Sunday. Commissary works the same way. Marked up snacks, marked up hygiene products, marked up everything, sold to a population that has no competing store to walk into, no ability to comparison shop, no option to just wait for a sale. It's not really a prison at that point. It's a captive retail market with a 23-hour lockdown built in and a customer base that literally cannot leave to shop somewhere cheaper. Stack the per diem, the phone commission, and the commissary markup on top of each other, and you start to understand the actual shape of this business. You think the money is in the crime. Actually, it's in the contract terms, the phone bill, and the vending machine. 3 separate revenue streams stacked on top of a single guaranteed body. Now, here's the bad scenario. Because this business, for all its clever structure, is sitting on a foundation that can shift under it overnight, and has more than once. First, it lives and dies by politics in a way almost no other industry does. In 2021, a federal order moved to phase out private prison contracts from 2 major federal agencies. Overnight, a chunk of one major company's business simply stopped being legal to renew. Contracts worth hundreds of millions of dollars, gone with a single signature. Then a change in administration reversed that order, and suddenly the same company's federal detention revenue was climbing again, driven largely by a completely different agency, immigration enforcement, whose budget for detention beds ballooned by tens of billions of dollars in a single piece of legislation. One company's quarterly detention revenue from that single federal agency more than doubled in the space of about a year. That's not a stable industry. That's an industry tied to whoever wins the next election and whoever they appoint to run a handful of federal agencies afterwards. Second, the phone and commissary side, the part that quietly pads the margins, has been hammered in court and in regulation at the same time. Major prison telecom providers have paid out multi-million-dollar settlements over allegations of price fixing and misleading customers about where their money actually went. One settlement alone topped $20 million. Federal regulators have moved to cap per-minute phone rates, pushing some state rates down towards just a few cents a minute. Every time a state cuts a deal to make calls free for families, and a handful now have, that's a real, measurable dent in a revenue line that companies had quietly come to depend on for years. Third, reputational risk, and it's not abstract. Institutional investors have divested, banks have faced public pressure over lending to the industry, to the point that some private prison operators have publicly lobbied for legislation that would penalize banks for refusing to lend to them, essentially asking lawmakers to protect their access to capital by force, because the market wasn't doing it for them. Political contributions have flowed heavily towards whichever party is more likely to expand detention contracts. That's not a company quietly doing its job. That's a company that has to actively fight every election cycle to keep the tap open. So, you've got a business with high fixed costs, a revenue model that depends entirely on a government staying willing to sign the same kind of contract indefinitely, and a growing legal and reputational shadow hanging over its most profitable side hustle. Every layer of the revenue stack we just walked through, the per diem, the phone commission, the commissary markup, has its own separate political and legal exposure. That's 3 different ways this business can lose money, on top of the one big way it can lose the entire building's purpose overnight. That's the trade you're actually making when you buy in. And it's worth pausing on how fast this all moves. An executive order can erase a revenue stream in a single afternoon. A single piece of legislation can hand it back, bigger than before, a few years later. Try building a 10-year financial model around a business whose single biggest input, how many people the government decides to detain and where, can flip with one election. Most industries plan around demand curves and interest rates. This one plans around who's sitting in the Oval Office and which agencies they've decided to fund. The verdict. Let's run the numbers 2 ways. Small operator, single facility, call it 2,000 beds, guaranteed occupancy near 95%, a per diem rate in the neighborhood of $50. Do that math, and you're looking at somewhere around $30 to $35 million a year in baseline contract revenue, before phone commissions, before commissary, before the healthcare subcontract, before a single vending machine sale. On paper, against an entry cost in the tens of millions, that payback timeline can look genuinely attractive. 5, maybe 6 years to break even on the facility alone, faster once you layer in the ancillary revenue. But you're also the one absorbing every risk we just talked about. A staffing shortage is your problem at 2 in the morning. A lawsuit over a death in custody is your name on the filing. A change in state policy that ends the contract early is your empty building, your idle debt, your unsellable asset, because who else is buying a prison? Now the big chain scenario. The 2 largest publicly traded operators in this space combined pulled in revenue north of $4.5 billion in a recent year, with one company alone reporting a quarterly jump of roughly 10% as a single federal agency's detention needs expanded, and another growing its detention capacity to tens of thousands of beds in the same stretch. That's the scale where the guaranteed minimum clause stops being a nice-to-have and starts being the entire business model. A portfolio of dozens of facilities, each one a small, steady drip of government-backed cash flow, insulated from any single local economy, any single sheriff, any single county budget fight. But here's the comparison that actually matters, and it's the one nobody selling you on owning a prison wants you to make. If you'd simply bought shares in one of these companies during a period of expanding federal detention contracts, you'd have captured the upside, the earnings jump, the stock climb, without ever touching a per diem negotiation, a staffing shortage, a lawsuit over call pricing, or the operational nightmare of running a building full of people who cannot leave. You'd have gotten the returns of the business without absorbing a single ounce of the operational risk of the business. No 2 a.m. phone calls, no inspection reports, no name on the wrongful death filing. Owning the facility gets you the headline revenue, the tax bill, the liability, and the sleepless nights. Owning the stock gets you the same upside in your sleep with an exit button the operator itself will never have. You can sell your position in an afternoon. They can't sell a half-built prison in a county that just voted to shut it down. That's the real ending here. This was never a business about crime. It was always a business about guarantees. The guaranteed bed, the guaranteed occupancy, the guaranteed phone commission. And the sharpest guarantee in the whole model isn't written into any prison contract at all. It's the one you get for yourself the day you decide you'd rather hold the paper than run the building. Something to sit with next time you hear this framed as a story about justice. It was never that. It was always just about who signs the contract and who's smart enough to stay one step removed from it.